Imagine spending more than you earn, not for a month, not for a year, but for decades. For a person, that would mean bankruptcy. But some countries have done exactly that, buying more from the world every year than they sell, and the system didn't collapse. How is that even possible? And what are the consequences, in the short run and over the long run? For an individual household, persistent overspending would eventually mean either exhausting savings, selling assets, or losing access to credit. Banks would tighten lending, interest costs would rise, and financial options would narrow. The idea that such a pattern could continue indefinitely would seem unrealistic. Yet at the level of entire national economies, similar patterns have sometimes continued for decades, which suggests that something very different is happening in how global finance actually works. Earlier in this module, we saw how different monetary systems shape economic discipline. Hard money systems imposed discipline directly through the limits of the monetary base. Fiat systems made the monetary supply more flexible, shifting that discipline toward financial institutions and policy decisions. And in the previous episode, we saw how this flexibility allows modern economies to sustain large debt structures that depend on continuous refinancing. But debt does not only accumulate inside national borders. Once economies are deeply connected through trade and finance, obligations can move outward as well. A country that spends more than it produces does not always adjust immediately. Instead, the imbalance can be financed by the rest of the world. This means that what looks like a simple trade imbalance, buying more than selling, is often really part of a much larger financial relationship linking national economies together. So if countries can keep spending more than they produce for years, where does the money actually come from? And what does the rest of the world receive in return? When a country imports more than it exports, it is effectively spending more abroad than it earns from selling its own goods and services. At first glance, that sounds unsustainable. But in practice, the difference does not simply disappear. It has to be financed. The money that flows out to pay for imports returns in another form. Foreign exporters, investors, or institutions end up holding financial claims on the deficit country. These claims can take many forms. They may buy government bonds. They may purchase corporate securities. They may invest in real estate, infrastructure, or company shares. In other words, the goods flow one way, and financial claims flow the other. In modern global trade, payment rarely means physically transferring piles of currency that simply disappear from one country and accumulate in another. Instead, exporters typically reinvest the proceeds they receive. Central banks, sovereign funds, corporations, and financial institutions all need places to store savings safely and productively. Large, liquid financial markets therefore become natural destinations for these funds, meaning that trade flows and investment flows quickly become intertwined. This is why persistent trade deficits are always matched by capital inflows, and persistent trade surpluses are matched by capital outflows. What looks like a trade imbalance is really part of a larger financial exchange between countries. But if every deficit automatically creates financial claims, why are some countries able to keep running deficits for decades while others cannot? In theory, trade imbalances should correct over time. A country that keeps importing more than it exports should eventually face rising borrowing costs, falling currency value, or declining access to financing. But in practice, some countries remain highly attractive destinations for global savings. Investors, institutions, and central banks may actively want to hold their financial assets. Large, stable economies often provide deep financial markets, widely traded government bonds, strong legal systems, and currencies that are broadly accepted in international transactions. This means that global savings do not simply stay where they are generated. They tend to flow toward countries whose financial systems are perceived as liquid, stable, and reliable. As long as those inflows continue, the deficit country can keep importing more than it exports without immediate adjustment. The trade imbalance is effectively sustained by the rest of the world's willingness to hold its financial assets. Over time, this creates a structural relationship. Some economies become persistent providers of savings. Others become persistent absorbers of those savings. This relationship can reinforce itself. Countries specializing in exporting goods may accumulate large financial reserves, which are then reinvested abroad. Meanwhile, countries receiving those investments may experience stronger domestic consumption, deeper financial markets, and continued demand for imported goods. What begins as a yearly trade difference can gradually evolve into a long-term structural pattern connecting production, consumption, and finance across borders. Before we continue, if you think this is valuable, please like. It helps share it with others. Subscribe so we stay informed together. But if this entire structure depends on the continued willingness of investors and institutions to hold those assets, what happens if that confidence ever begins to weaken? As long as capital continues flowing into a deficit country, the imbalance can remain stable for many years. Imports continue, investment continues, and the financial system keeps functioning normally. But underneath this apparent stability lies an important condition. The entire structure depends on the willingness of foreign investors, institutions, and governments to continue holding the financial claims created by those deficits. Government bonds must remain attractive. Corporate assets must remain investable. The currency must remain usable in international transactions. In other words, persistent trade imbalances do not run primarily on trade flows. They run on confidence in the financial assets that finance those flows. When that confidence holds, even very large imbalances can persist for decades. But if confidence weakens, if investors begin questioning future stability, repayment capacity, or currency strength, capital inflows can slow, borrowing costs can rise, and the adjustment that was postponed may begin to unfold. What looked like a stable financial relationship can suddenly become far more sensitive. So if global imbalances ultimately depend on continued confidence, what happens when the accumulated claims themselves grow so large that markets begin to question how sustainable they really are? Over long periods, persistent trade imbalances do not simply represent yearly flows of goods. They gradually build up a stock of financial claims between countries. Surplus economies accumulate increasing amounts of foreign assets. Deficit economies accumulate increasing obligations to the rest of the world. As long as growth remains steady and financial markets remain confident, this accumulation can continue for many years without immediate disruption. But over time, the scale of these claims can begin to matter. The larger the accumulated obligations become, the more the system depends on continued refinancing, stable currency expectations, and the belief that those assets will retain their value. At some point, markets may begin to reassess how sustainable the existing balance really is. This does not necessarily happen suddenly. It can unfold gradually through shifting exchange rates, changes in investment flows, slower growth, or policy adjustments aimed at stabilizing the financial relationship. What defines this phase is not that trade stops, but that the accumulated claims begin to shape how countries adjust their policies, currencies, and financial systems. In this sense, global imbalances behave much like debt cycles inside a country. They can persist for long periods while confidence holds, but they also carry structural limits that eventually require some form of adjustment. So if global trade imbalances ultimately reflect financial relationships built on accumulated claims, how do governments respond when those imbalances begin to threaten financial stability? Trade balances are often presented as simple measures of exports and imports, but in modern economies, they are also records of financial relationships linking national balance sheets together. Persistent deficits create obligations, persistent surpluses create claims, and over time, those accumulated claims begin to influence currencies, investment flows, and the policy choices available to governments. As long as confidence holds, This global system of exchange and financing can remain stable for long periods. But when imbalances grow large and financial relationships become more sensitive, governments rarely remain passive observers. They begin looking for ways to stabilize markets, manage capital flows, and protect their financial systems from sudden shifts in confidence. In the next episode, we examine one of the most important tools states use in these situations, financial repression, and how it allows governments to manage debt, capital, and stability when economic pressures begin to rise. Trade balance and imbalances is part of TNBC Explainers Module 3, Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list, or visit thenextbigcycle.world for the full course overview and background. This is The Next Big Cycle. TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time. Share it with others. Subscribe so we stay informed together.